What's going on, guys? This is Will from Market Rush Trading, and here, as you guys can see, we do have the intro to options. This is our first page of our first book that will be available to you guys on July 20th. Just today, I want to make this snippet video for the newcomers and the new members to our community, just so you guys can have an idea what option trading is. So as you guys can see, this is the first page of our book. We'll be going over today what are options, the two components of options, and in the money, at the money, out of the money trades, right? So what are options? Options are financial derivatives that gives buyer the right, but not the obligation, to buy or sell an underlying stock at a specific strike price and a predetermined date. Now, why do we trade options? Again, we want to control shares without actual ownerships. We control more stocks with less money, right? Because if you were to think of the Amazons, the Teslas, or the Apple, they are too expensive to own. So we trade the options in order to get the appreciation. And whichever the condition that the market is in, we'll be able to profit from it, to benefit from it. Another reason why we trade options is to hedge our portfolio. In terms of a down market, there's different strategies as mirrored put, spreads, iron condor, which you could play in order to protect your assets or whatever your holdings are. Now, what is in the contract? In the contract, we have the underlying stock, we have the strike price, and the expiration date. Now, as you guys can see on this board here, we have certain things for you guys. Now, before we move on with the video, let's keep track of what short is. So short is to sell, to go long is to buy, right? Just keep that in mind. So as of right now, we have the options, two parties, which includes a buyer and the seller. Right, the buyer has the right, but the seller has the obligation. Then we have the underlying stock. Now, what is the underlying stock? The underlying stock is the stock of your choosing, of course. The strike price is the fixed price that you speculate the stock will move to, whether on the upside or downside. Expiration dates, which is over here, expiration dates are the last day that the option contracts are valid, since you do not own the shares. They expire. Premiums are what you pay to control those 100 shares or to buy that contract. Now, what is a call option? A call option is the purchase of a contract which indicates that the price of the underlying stock will be moving to the upside for a specific period of time. Thus, what we call a bullish market. Now, on the other side, we have what we call a put options, right? This indicates that price of the underlying stocks will be moving downwards with a specific period of time. Thus, we call that a bearish market. Now, in the middle here, as you guys can see, I have in the middle all the things that affect an option contracts in terms of implied volatility, in terms of Greeks, in terms of volume, in terms of open interest. Now, on each side of the spectrum, we have in the money trades, at the money, and out the money. Now, what do I mean by in the money trades and at the money or out of the money? Simply, for the call options, in the money trades are trades that have intrinsic value. What do I mean by intrinsic value? Those are calls with strikes below the current market price of the stocks that you're trading. So, for instance, if we were to go on Costco, right? So we have Costco is trading at $300 a share. If you want to go on the call side, matter of fact, hold on, let me put that to the right side because I already have that example over there. So Costco is trading at $300 a share, right? So an in the money trade for Costco would be a $290 call, $295, anything under the current market price of the stock itself. At the money means that anything closer to what the strike price is, the current strike price, the current market price of the company is. So if Costco is trading at 300, at the money play would be the 300 call, the 301 or the 302. That would be at the money. At the money call options for Costco would be the 302, 305, 310, 315. That's what at the money is. With at the money trades, they have no intrinsic value. For call options, at the money or strikes above the current market price of the companies that you're trading. Vice versa on the other sides. And out of money trades for the put options would be strikes below the current market price of the stock that you're trading. So like in the money for the puts would be if Costco's trading at 300, right? In the money puts would be the 301, 302, or 303, 305, right? Those prices are trading above the current market price of the stock. At the money again would be a 300 or a 299 or 301. That would be at the money. At the money, of course, would be a 298, 295, 280, which are less expensive than in the money and at the money trades. Now, we're going to go a little bit in terms of meeting the Greeks. Those are what really affects an option contracts. Now, the Greeks oversee certain domains such as price, times, and implied volatility. So they help us as traders to measure risk and potential of an option stance. So what do I mean by that? They can help you determine whether you should get into an option contract or not. So for example, give me a second. For example, let's go back over here, right? Let's say you guys wanted to play, matter of fact, let's just give you guys the definitions. So the first part of the Greeks we got delta, right? We got gamma, we got theta, and we got Vega, and we got rho. Now, delta, what is delta? So delta is an estimation of the option price expiration while in the money. So now what that means is, right, for every dollar that the price of the stock moves, the delta is what the option price moves, right? So now, what are the gammas? Gammas calculate the amount the delta changes in comparison in the change in stock price, right? Now, theta is our best friend and our worst friend depending on which side of the trade that we're in, right? Now, theta has to do with duration of time, right? This is how much you're losing every time the trade is going against you or the trade isn't moving at all, right? So this is the hypothesis on the amount of value the option may decline each day passing close to expiration date of that contract. Now, what is Vega? Vega basically just measures the volatility. So this one acknowledges the sensitivity of an option during volatile price swings on primary stocks. And literally, which we don't use the rho as much, this literally has to deal with interest rate. Most traders, they don't look at that, but if you do, you could kind of pay attention to that. But yeah, guys, this is basically it for today. Just wanted to make sure that you guys do understand what they are. The volume. Now, if you guys look at the volume or how many times these contracts are being traded. So if you want to go into a contract, you want to make sure that it has a pretty good volume to it, right? Most of the time you see that people are buying the open interest. The open interest is literally the amount of contracts available to trade in the market. Implied volatility just shows you how volatile the stocks can be. So anything above 50% is really good, but you don't want it to be above 80 or 100%. So with an implied volatility of an option contract above 90%, it's simply just saying that you could easily be in profit and at the same time you could easily lose it as well because it's pretty volatile. Now under here we have option strategy that we could use. We could start with the spreads, so like debit or credit spreads, right? Debit spreads is a bullish strategy. Credit spreads or bearish strategies. We have straddles and we have strangles. Now, a straddle consists of buying the same strike on the put and call side for the same expiration dates, while the strangle is buying two different strikes, two different expiration dates, however you want to put it. That's basically what that is. Now, how do you do a debit spread? And as I said before, there are many different strategies you can play in order to reduce the premium paid to get in those option contracts. And one of them that we're going to go over today is called a debit spread. So now the debit spread allows you to receive a net debit, right? It's the difference between the two strike spreads that you're taking. But remember, your profits are limited to the difference of those two strike price minus the premium paid. That's how you calculate your profit. This is how you would place it. So you go ahead, trade options, choose the expiration dates that you want to trade. From the expiration date, now we're going to actually buy an in the money trade. So at first, we're going to click on select on the right top side of the screen. We're going to buy in the money call option, and we're going to sell an out of the money call options. So we could sell the 220 250s. Now separately, if you guys were to purchase these things, it would cost you $903 to buy the 220, $775 to buy the 220 250 calls, right? So now if you click here, you see that it says call debit spread. We're going to sell the 220 250, acting as our barrier, that support that we need, right? That's why we're receiving that net debit, which is the difference between the two. And at the same time, we're buying, so we're not going naked. This is a strategy that you could play if you don't want to risk a lot of money. You're capped to making 128. You're capped to making however much you spent, which is $128, which that's 100% of your money. At that point, it's a safer way to trade, right? Now, instead of you paying $700, $900 per naked options, you're only paying $128 for this strategy here. Now, the other strategy that I'm going to teach you guys is called a net credit, right? So the net debit that we did, the debit call spread, is a bullish indicator. So you would want to play that if you think that there's going to be an upward movement in the stock price, right? But in the case that you bearish but not really too bearish, and you do not want to risk a lot of money, you could do what they call a credit call spread, which is a minor bearish strategy. So again, you're going to select, you're going to buy first, of course. Now you're going to buy an out of the money play. So let's say you want to buy in the 220 250s, but at the same time, you're going to sell an in the money trade, which is the 220 or the 1750. So let's keep the same prices, which is the 220 call. At that point, you get a call credit spread of $1.28, guys. Those are different ways. If you're bearish about the stock, as long as it stays in between those, you'll be making money on it. But those are different ways that you can take advantage of not spending too much money. Now, again, remember, per contract is 100 shares. So whatever numbers y'all see in total credit, you multiply by 100, that's how much you're really paying, which is $128. Now, for those who got enough capital but wants to hedge their positions in terms of the options, there's what you call a straddle. A straddle is when you play the same strike price, same expiration dates, for the puts and call options. So let's say tomorrow evening, I feel like FedEx could run. So let's try FedEx on this one, because we actually got FedEx contracts. As you guys could see, FedEx is at 136 right now. This is a current video I'm making for you guys. And I was already up $54 before the market closed. And right now we have the 134. It's at 136. So let's say for earnings, I really wanted to, I really believe in it. And I didn't want to take the risk without being protected. And I know that this market is very choppy, right? It can move either way, even with good earnings. So here, I could trade options, go to July 10th. And one of the ways that I could play this, press on select. This is what you call a straddle. So at the same time, we would be playing this 134 call, simultaneously playing the 134 put, which this would be a lot expensive. That would be $1,238, right? But I'm protecting myself either way. Since I'm in the money, I could benefit from the downside. And because of time that I have in those contracts, I could also benefit to the upside as well, right? Now, the next strategy, which is a lot cheaper but still pretty expensive, is called the strangle. The strangle is the same expiration date, but you're able to choose different strike prices, whether on the put side and on the call side, to bring down the premium paid. So you go here to select, right? And you're going to actually, let's say we purchase in the $134 call. To make it a lot cheaper, remember, we're keeping the same expiration date. So to make it a lot cheaper, we're going to the put side, but we're going to pick something cheaper because we do not want to spend a lot of money. So let's say we pick the 125 put. At that point, if you click here, you guys see you pay strangle. Now the strangle allows you to pick up different strike to bring down the premium a little bit, right? But those are the different strategies that you guys can use in order to take advantage of the market, not risking too much or protecting yourself, right? There's different ways you could use options to hedge your positions, whether you're owning stocks or not even owning stocks. Hedging your position is key, guys.
Thank you for watching. I hope you enjoyed and learned a lot from the video. Go ahead and smash that like and subscription button, and follow us on social media for more content. And stay tuned for the next video.